Okay, so when AI requires actual megawatts just to function, power efficiency isn't really a luxury anymore. It is just basic survival.
And that is exactly how you sell a lot of networking components to hyperscalers right now.
Right. It is March 16th, 2026, and we are unpacking Semtech, ticker SMTC, and their fourth quarter results. And honestly, it is a fascinating print because they are basically re-architecting their entire future around AI and smart connectivity. But the balance sheet is just, well, it took a beating to get there.
It really did. Look, the top line is fine. Revenue came in at $274.4 million, which is up about 3% sequentially. But the profitability metrics are running in completely different directions depending on where you look.
Oh, before we get too deep into the accounting carnage, just a quick reminder that this is all just our personal opinion and definitely not financial advice, so please don't sue us.
Yeah, please don't. But seriously, you have adjusted earnings at 44 cents a share, which is a slight dip from 48 last quarter. Pretty standard. But GAAP net income? That is a rather sharp loss of 32 cents a share.
Yeah, because they just took a very quiet $42 million goodwill hit on the chin. Like almost zero explanation in the prepared remarks, just sort of buried it in the filing.
Which is exactly why the stock tape looked completely schizophrenic after hours. I mean, they closed regular trading up nicely, then immediately gapped down to around $84. And then during the call, as management is, talking up their new AI optical modules, the price whipsawed all the way up to $94 before settling around $88. People literally didn't know how to price the legacy junk against the new AI pivot.
Well, speaking of that pivot, the underlying business stories are actually kind of incredible. Data center and market revenues jumped 12% to $63 million. They make these ultra low power networking chips, right? So you can essentially run a 5G router off a tiny solar panel on some remote oil rig. But my favorite part is how they're actually funding their new high-end optical fabrication.
Oh, you mean the used equipment hunt?
Yes! They bought this shiny new California laser company, HieFo, and to keep costs down, the CEO basically admitted they are scavenging the new and used market for fab equipment. It is just so wildly scrappy for a tech player building AI data center tech.
It is. Well, it's extremely pragmatic. CapEx was actually absurdly light, just $2.4 million this quarter. But to your point, if they want to pull off this transition, we really need to look at what they're actively shedding from the portfolio to afford this future.
Absolutely. All right, let's get into the details on that.
Right. So the detail that matters here is that the legacy cellular IoT business is practically out the door.
They are actually selling it? I thought that was still just a strategic review rumor.
No, it is actively happening. The CEO explicitly said the buyers are now paying for external consultants and legal diligence. His exact phrase was, when there is additional skin in the game, it points towards a successful conclusion with the divestiture in the near term.
Skin in the game, meaning the buyer's lawyer meter is running? That usually speeds things up.
Exactly, which totally explains that massive goodwill impairment we talked about. They're basically clearing the deck. You write down the legacy junk so you can re-architect the whole balance sheet around this new data center pivot.
Okay, but how big is that pivot really? Because buying a laser company with couch change and used equipment sounds incredibly risky.
It is risky, but the math is compelling if they pull it off. By bringing those indium phosphide lasers in-house, management thinks they can increase their content opportunity from high single-digit dollars in an 800G module to about $80 in a 3.2T module.
Wow. Oh, sorry, wait. From $8 to $80 per unit? That is a 10x multiplier.
It is a massive jump. They are literally trading low-margin cellular baggage for a vertically integrated AI data center play. It is a completely textbook capital structure pivot. But they aren't abandoning IoT altogether. They're just moving it to the suburbs.
Oh, right. The Amazon Sidewalk integration. Yes, this is actually my favorite narrative from the call because for years, LoRa, which is Semtech's low-power network protocol, was basically just for, smart agriculture or monitoring oil pipelines. Very B2B, very industrial.
And notorious for false starts in the broader consumer space. People have been waiting for the mainstream use case for half a decade.
Yeah, exactly. But starting this March, Amazon's Ring is finally rolling out security and home control sensors across North America that run natively on Semtech's LoRa chips. So they are just piggybacking on this massive consumer mesh network. The CEO called it a significant evolution from its industrial roots to mass market consumer adoption at Amazon's scale.
Which makes perfect sense financially because you bypass the telecom carriers entirely. It is a much cleaner margin profile if Amazon does all the heavy lifting for consumer distribution and you just provide the silicon.
Right. It takes them out of the niche and puts them in basically every neighborhood. But zooming back to the data centers for a second, is that $80 module play entirely reliant on those new lasers?
No, actually. And this is a nuance the market misses sometimes. Copper is not dead. They are shipping what they call 1.6T copper edge for hyperscaler deployments next quarter.
Because optical uses too much power for really short distances, right? Like within the same server rack.
Precisely. If you just need to connect servers right next to each other, you use active copper cables with analog tech to save power. As the CEO pointed out, when data centers are measured in megawatts, saving power at the network layer is no longer just a differentiator, it is an enabler.
Because if you max out your power grid, you literally cannot run the AI compute. The networking has to be essentially invisible from a power draw perspective.
Bingo. So they are attacking the data center constraint from both sides. Copper for the short hops, newly acquired optical lasers for the long hops, while simultaneously tossing the old cellular business overboard to pay for it.
That is a tremendous amount of moving parts for one company to manage at once. It really feels like they are stitching the parachute while falling. So where does this leave their actual trajectory heading into next quarter?
Well, the parachute seems to be holding for now. Heading into the first quarter, they are actually guiding for steady sequential growth. They expect revenue to hit $283 million, which keeps that data center momentum rolling with another projected 12% increase.
Okay, so the AI narrative is it is actually translating into consistent quarterly demand. That is really rare for a hardware transformation this complicated.
True. Although the underlying mechanics are still pretty strained, their adjusted gross margin is basically flatlining at 52.8% for next quarter. And actually, here's the kicker. Their non-GAAP tax rate is suddenly jumping up to 17% this year.
Wait, jumping up from what?
From 15. Management blames a geographical shift in pre-tax profits, but that directly hits the adjusted EPS guide, which is sitting at 45 cents. Combine that with stock-based compensation that is just stubbornly stuck at over $16 million a quarter, and the actual fundamental profitability is extremely tight.
Which loops us right back to why they are literally hunting through the used market for factory equipment to build next-generation optical lasers. They simply do not have the margin of error for bloated spending.
Exactly. The CEO actually promised on the call that the required fab expansion, quote, can be easily supported with, say, for example, 1/4 of the free cash flow.
That is honestly either brilliant capital discipline or, just wildly naive for outfitting an advanced semiconductor facility.
Most likely both. The market is absolutely giving them the benefit of the doubt right now because the divestiture is cleaning up the story. But the real tell next quarter is pure execution. If that new copper edge product ramp slips even slightly, or if the cellular sale drags out, this tightrope walk gets very dangerous.
Right. The strategic dreaming phase is essentially over. Now they just have to prove they can manufacture the hardware without blowing up the balance sheet again. And preferably without another surprise $40 million impairment.
Yeah, let us not get greedy with our expectations.
Fair enough. All right, I think that is a perfect place to leave Semtech to their factory upgrades.
All right, if you like unpacking these earnings drops with us, you can just follow this show so they show up for you automatically. Just a quick reminder that we use AI to help generate this podcast, like quickly scanning those massive financial filings to find the real story faster. If there's a ticker you want us to look at next, drop a note to earningsunscripted@datamadness.ca or hit the X link in the show notes. Thanks for hanging out, and we will catch you after the next bell.
See you next time.